Conversations, our new video and interview format on twoquants.com. Now, before we begin, I thought it might make sense to give you some background on why Moritz, my business partner at TwoQuants, and I came up with that idea. It is because we like to have great conversations. Great conversations with great people, smart traders, and bright minds. People who are able to challenge our own views so that we can learn something new. Naturally, some of these people are flying under the radar, and that means they aren't easy to find, which is exactly why you should not be expecting us to be launching a new video every week or every month. It just happens when it happens, and we only want to do it when we think it's worth our time and your time. So today, we will be speaking with Greg Zuckerman. Greg is a writer at the Wall Street Journal and the author of many popular books, among them The Frackers, The Greatest Trade Ever, and most recently, The Man Who Solved the Markets. The Man Who Solved the Markets is a book about the secretive quantitative hedge fund RenTec, or Renaissance Technologies, the people behind the firm, and of course, first and foremost, its founder, Jim Simons. I will be conducting the interview together with my friend George Coyle from Chicago. Reason being is that George and I have in recent months published a 3-part series on RenTec and on the book. And in the latest part, part 3, which we published earlier this year in January, we touch on what we think RenTec might actually be doing. Of course, we don't know. We don't know anybody who works there. And even if we did, we wouldn't have access because these people are subject to an NDA. There's many people out there who believe that RenTec is running an AI-based and dimensional short-term trading system. And again, that may be true, but it could also be that they're running a basket of simpler trading systems, short-term, with high leverage and very low slippage. We thought it might be a good idea to ask Greg directly about it because Greg is the person that has come closest to the firm and its people. Now, before we start, I need to get one thing out of the way, and that is that nothing that we say or discuss on that show should be thought of or taken as investment advice. Now, with that out of the way, enjoy the show. Moritz Seibert here, together with George Coyle, running our first conversation on 2Q Conversations, together with Greg Zuckerman, who we're very happy to have with us today. Hey guys, welcome to the show.
Great to be here.
Hey. Yeah, likewise.
Fantastic. So I thought before we get going, people probably do know Greg Zuckerman, books such as The Frackers, The Greatest Trade Ever, most recently, The Man Who Solved the Markets. I wanted to give George an opportunity to introduce himself. George is a good friend of mine, has worked with me on a couple of interesting articles, most recently about RenTec. And those articles we've published on Twitter, LinkedIn, on our website, twoquants.com, and they've become very popular, thousands and thousands of views, lots of comments on them. So George, how about you tell us a little bit about yourself?
Sure. I'm George Coyle. Hello, everyone. I produce independent research via my firm, Triangulated. I also work with a family office in Chicago designing different investment strategies, and I've been designing trading systems for a little over a decade, so a lot of interest in RenTec, given they're the best at it, seemingly. So anyway, that's me.
My name is Greg Zuckerman of the Wall Street Journal. Been there since 1996, so a long time. And I'm an investigative reporter right now, but I generally write about the buy side. Hedge funds, a little bit mutual funds, a little bit VC and private equity, that kind of thing. But a lot of my work's been on hedge funds and people moving the markets around.
Fantastic. And things are moving, not only GameStop and things like that, but, one thing we noticed, and, being quants, we cannot resist and call that causation rather than correlation. But ever since George and I have published that article, it just so happened that Jim Simons decided to step down. That's probably because of us. I'm just kidding. But I'm just wondering, have you been in touch with the guys at RenTec or with Jim Simons in recent weeks? Have you heard about them? How are they doing?
Yeah, so I do check in periodically. My book came out end of 2019, but they're still a fascinating firm to me and to others. So Jim hasn't really been playing a day-to-day role at the firm for a good decade or so, but he would go in every month and chair a meeting and take about $1 billion out of the firm each year. Not a bad job if you can get it. But yeah, I do check in periodically, both to figure out what's going on within the firm, but they have unique takes on the markets, and I'm interested to see if they can keep this winning streak going. I'm a cynical, maybe skeptical reporter, so I keep waiting for them, at least Medallion, to have troubles. And last year they were up a lot, so it hasn't happened yet. But markets are changing, so I'm always interested to see how they can adjust.
Well, I had a question, if you don't mind, if we just kind of jump into that type of stuff, Greg. I was reading through the book last night, and I think it was the prologue, but you were talking about it's a passion project, and what you didn't really describe is how it came to be, or maybe I missed it. But I'm just curious, like, how did you even kind of get this started? I know you were talking to somebody in Massachusetts over lunch, and that led to other interviews, but how'd you get interested in the topic, all that type of stuff, if you could expand a little bit?
So, like you guys, if you're in these markets, you hear about RenTec, you hear about Medallion, and it's always out there as the mystery. These numbers are crazy, up 66% a year on average since 1988. So it was always something I was sort of interested in, borderline obsessed with. I approached Jim a while ago, maybe a decade ago, about doing a book about him, and he had no interest. And then, I don't know, I guess 5 years or so, I said, you know what, I'm just going to do it anyway. I had read that the book about Elon Musk, and Ashley Vance started off similarly, not getting access to Elon Musk, and eventually Musk came around. So I was hoping it would be something similar, but I was nervous. I was scared, frankly. I'm in my office right now in New Jersey, and right on my desk here, I had my book advance, and I didn't cash it because I knew if I cashed it, I'd spend it, and if I spent it, I wouldn't be able to give it back. So I wanted the ability to give it back because I wasn't sure I could get access. And yeah, it was hard. It was, even as I was making progress, I was still not getting access to Jim and his colleagues. But eventually they came around. We can kind of discuss why, but it was the hardest thing I ever did.
Interesting. So, George and I, we were talking, and, we're both quantitative traders. And, all of the quantitative traders out there, they kind of like look up to RenTec because nobody is just like them, right? And you sometimes wonder why. Why is it? Why is there one firm, one quant trading firm that just outperforms everybody else year after year over and over and over again? And you could kind of think, well, there's enough firepower out there in terms of capital, be it the Two Sigmas or D. Shaws and, maybe Wintons of the world. All of them have money. All of them have very clever people, and all of them can collaborate. So why, in your opinion, is there no second RenTec?
It's a great question. It's one I have struggled with and have theories and hypotheses. So it's my contention that there's no one simple explanation. They have a series of advantages over everybody else. And in and of themselves, they're probably not enough, but you add them all up together and you get these returns. But before I get into them, I do have to make the point that people within the firm aren't sure. Partly because they aren't very familiar with the strategies of others. People at RenTec are a little more focused on Facebook and Google and other tech companies because they're competing against them for talent a lot of the times. They don't really have an interest in what Goldman Sachs is doing or what Two Sigma is doing. And they're really they're not in that world. They're out in Long Island. They're former scientists and mathematicians. They don't interact. They don't go get drinks after work with people from these other firms or prime brokers. Or they're not in that world. And then when they leave, they go back to academia or nonprofit world. So they kind of say, Greg, we're not sure what other people are doing. We're not sure why we're so much better. And I think they're being frank with me. I don't think they're being misleading. These are people that I trust that gave me all kinds of information, and it proved accurate. So that's how I preface the answer. And I will suggest that they have a series of advantages. So among them, they get better terms from Wall Street than almost anybody else in terms of leverage, in terms of the costs. It allows them to do trades and that others can't do. They get those terms because their Sharpe ratio is better than everybody else. it's a virtuous cycle in some ways. They have a structure in terms of management, how they have incentives internally that is different than other quants. So I've talked to people at Two Sigma, I've talked to people at AQR and other kind of firms. They're not set up like RenTec is, and we can get into it if you'd like the details. But they structure, and people internally, I've been told, and I think I write in the book that Jim Simon's genius is managing genius. So it's as much a management book. After I finished it, I realized as it is a book about trading. So there are a series of different things. Each of them, again, not enough to explain it, but when you add it all up, I think it does help. You know, I thought about doing a page in the book, just sort of laying it all out, and I sort of regret not doing that. Maybe for the paperback, I will. I thought people would, along the way, I think I get into all the different advantages. They're all in the book, but I do regret not laying them all out for people.
It's interesting stuff. Thank you for sharing. One of the things, that I took from the book, and I just made some notes here that I'm going to look at, but, there's kind of four things that stood out to me that I thought were primary drivers of their success. And, I'll list them, and I wondered, if you could potentially rank them, which is obviously based on your opinion. But one of the things they did different was they collaborate. I don't think a lot of firms collaborate. A second one is, they probably had some unique trading models, but my sense is that the world thinks that they have a better mousetrap, and that's certainly part of it, but not maybe a large part of it. The time they spent getting the devil, as you called it, or they call it, which is the difference between what they think they're going to get in executions and what they actually get in terms of slippage to zero, seemed like a big focus of theirs. And then, you mentioned this a couple minutes ago, but just the swaps with Wall Street enabling cheap leverage tax advantages. So those were, to me, sort of the four things: the collaboration, the trading models, the devil equal to zero, and then the swaps and the leverage. Do you have a sense of how you would rank those, or what percentage you would allocate to each one in terms of what drove their success?
Yeah, good question. So let's say the last one, in terms of their terms with Wall Street, they used to get really great leverage terms. That's changed over the last couple of years. A lot of the banks aren't as generous with leverage. They're getting a little nervous. And they had the whole controversy with the tax aspect of it, the basket options. So my understanding is that they're not getting those same terms. And frankly, RenTec, when I say RenTec, I'm really talking Medallion. We could talk about the other funds if you want later, Reef and such, and they don't do as well. And lately they've been struggling. But Medallion is the one we're sort of all obsessed with. So Medallion's terms were an advantage for a long time. They still are in terms of their costs, but in terms of leverage, not quite as much. And as a result, just recently they hold more cash than they used to. That should weigh on their returns. That said, these markets are really very suitable for them. Very volatile markets are what they model really well. They're very good at modeling short-term blips in the market patterns. They're not as good at longer-term stuff, which is why Reef and Ridge and Rita don't do as well. Those are the longer-term oriented outside funds. So Medallion does need volatile markets, and they're getting it. And yeah, so they had that advantage for a while. I'm going to go back to your first point about being collaborative. It's a fascinating organization in that, as you suggest, internally they're uber collaborative, but externally they're the most secretive firm you're ever going to come across. And it's patterned on the IDA. The IDA was this organization that Jim Simons worked for when he was a code breaker for the government. We're talking in the early 1970s, but they were going up against the Russians, and internally, he was hired to break code and to build algorithms, and internally they shared information, and that's sort of what his model was when he went into academia too. Jim Simons, he wanted people to be collaborative, and he believes that super smart people, when they work together, they accomplish a lot more than when they're silos. And you guys know better than I do, but my research sort of suggests that most firms have these silos. We're talking Quant Firms, but others as well. And we all sort of understand why they evolve. somebody, a man, woman does really well one year, maybe the firm doesn't do as well. You want to keep that person. You give them a mandate. You give them some autonomy, their own fund. They get to hire some people. And then those people are not so inclined to share information, to share ideas. They're competing to some extent with their colleagues. And that's not what happens at Renaissance. Renaissance, everybody works together. I don't want to suggest that it's kumbaya kind of thing, but there's an incentive there. Everyone's paid on how the Medallion Fund does. And someone said to me, and this is an exaggeration, but he said, Greg, if my job is just getting coffee for my colleagues, then I'll do that if it means they're going to do better and they're going to make money because I'm going to make money. And again, it's an exaggeration, but the point is just sort of finding new data sets, cleaning the data. It's all valued within Renaissance. It's a very flat structure. There are researchers. I mean, it's not to say that there aren't more powerful people within the firm, but in terms of titles and such, it's unlike most organizations I've come across. And in terms of power within the firm, I mean, look at Bob Mercer. He was a co-CEO, then he stepped down because his politics was really tearing the firm in half. But he's back to being a researcher, and he's in meetings, and he's collaborating, and he's working with people, and he's respected. So it is a very flat, collaborative organization. And the idea being that, one group is working on a project, and they meet resistance, they become frustrated, and they, instead of just sort of closing the computer, laptop, and walking on from the project, someone else can see what they did, and maybe they come up with an idea. And anybody in the firm, it's a crazy thing, anybody in the firm can see their 30,000 plus lines of code. And it used to be even like the secretaries literally could see all their super secret code. It's a crazy thing. And we can discuss about the risk, the IP risk that results and why it hasn't leaked out. But I do believe that structure is really crucial. And you talk about the devil. Yeah, we meeting in the press, in the media, but I guess people broadly, we don't focus enough on their ability to model their trades and realize when they impact the market and when they don't. I mean, it's not to say that everybody doesn't do that. Everybody focuses on that, but it was an early emphasis on the part of the people at Renaissance, and they pride themselves. They don't think they have some really good signals, obviously, but they think they're probably better than others on a relative basis on their ability to trade and ability to know when to trade.
So I guess this collaboration is probably valuable. To your point, I think most quant firms, they operate based on pots, right? You have one group that trades vol, you have one group that trades short-term systems, you have another group that trades long-short equity, whatever the case may be, and they do not have access to the same source code base. Right? They all do their own thing, and they're essentially monitored, right? When they come into the office, drop your cell phone, right? Drop any electronics that you have on you, log on in a secured environment, and when you leave, nothing leaves that building, nothing leaves that server, absolutely nothing. And if you ever even think about taking anything, we'll go after you, right? There's many of these examples. So in the case of RenTec, they have these severe NDAs, as we hear, right? So when you leave the firm, not many people, I guess, leave the firm. Why would they? Because they can invest in that beautiful fund, right? So you should stay with it. But they all can have a look, like you say, at the code base. That they all work on the same thing. And I guess that is probably where magic can happen. Because we're all just you only have one brain, right? And as a human being, once you kind of like engage in one style of trading, say you become the systematic futures trader or this trend following trading guy, some of those people find it then very difficult to step away from that and say, you know what, I'm going to use some different technique. I'm going to look at the markets from a different angle. I'll try out something that is not trend following. I'll now do, let's say, volatility arbitrage. You don't do that, right? But when you get them all together, they kind of like, it's kind of like you compound the brain power, it seems to me. And that's what they do, which then, that's one of the things that I want to ask you, sorry for the long-winded question, but it may then, you might think that what they're actually doing, even though they're like, scientists and they, come from the era of speech recognition and, all these, intense fields, maybe what they're doing isn't that much rocket science in terms of using manifolds and higher dimensional, systems that actually operate in the markets. Maybe it is the combination of really many, many rather simple short-term systems that gets those returns out of the markets.
I think there's something to be said for that. When I asked the people there about their computer firepower and such, that's not where they think they have an advantage. They are not high frequency. They have powerful systems, but it's not better than others. There is some argument that the way they collaborate is what their advantage is. And you say to yourself, well, why doesn't everybody build a firm like that? And like you said, you go to like a Millennium or somewhere, it's all pods, and frankly, it works for the other firms. And AQR works for them too. The returns may not be great, but they're billionaires, the founders. So one thing that I kind of discovered, because I went into this as a financial reporter, but not like a quant expert. And we in the media, and you guys know it better than I do, we in the media kind of say, well, quant did this and quant did that. It encompasses so many different kinds of strategies. And what they do actually they don't have that much competition. Medium frequency trading, not high frequency, medium frequency, sort of moments to months is the way they look at their holding periods, but it's generally a couple of days on average, I guess, and it could be shorter. It often is shorter, but we're not doing high frequency, and there, believe it or not, aren't that many people doing that. You got 2 Sigma a little bit D.E. Shaw, Pete Muller. One thing I discovered is not as much competition as you would think, and that helps them too. That's one of those explanations too. And there may not be that much capacity, and they that's another advantage. They keep that fund at $10 billion. Lately, it's actually expanded to about $15 billion. But again, remember, a lot of it's cash. I determined recently, so that's another one of their advantages. That unlike most other big managers that I've written about in my career, they tap that fund. I've written about people like John Paulson who got too big, and that's not a problem for Medallion. They cap that fund.
Well, one follow-up, if you guys don't mind, is just, I realize now the question I asked was not a great question for this format of interview, but to kind of recap, obviously your book uses the word solved. And I think when people think about solving the market, they think that guy really understands the market. He's got a better mousetrap. But hearing what you said, reading the book, it seems like it's not just, oh, hey, if you buy after 3 down days, that's the secret. The secret is everything combined. It's collaboration. It's making sure you can actually implement the models and get the devil to zero. It's having the models. It's a lack of competition. So it's the solving the model is not just we found the right formula. It's we found the right formula, which includes all of the other aspects of running the firm. Is that a safe summary, you think?
Yeah, I think that's exactly right. So listen, we call it the man who solved the market. That's the name of the book, but it's a conceit we use. They solved it, and yet they're scared about the future like anybody else is. There's an urgency within the firm, a nervousness about where things are going, whether they can stay ahead of everyone else. And sometimes their advantages dissipate. So for a long time, they had better data than everybody else. They collected it, they cleaned it. They were, before anybody else, making sure they're clean. And they had data going back literally centuries, 1700s, and they incorporated thousands. They didn't always use alcohol. Today, it's not as much. It really isn't. So they'll acknowledge that. Everybody kind of has great data. Today, it's all clean. So they've got to stay a step ahead. And it's this combination of these little things. And they have some discoveries I write about in the book, but some of them dissipate.
I remember, but maybe I got this wrong, that at the very beginning you said they got this leverage and they got, favorable leverage terms offered by Wall Street banks. Did I get that correct? And if I got it correct, why do you think this is? Why could they negotiate on better terms relative to other funds?
Yeah, they did get better terms. I think it's because their Sharpe ratio is so much higher than everybody else. So it felt like a safer relationship for the banks than for the next fund. And that's like a virtuous cycle. So you get better leverage, get better terms. You can do trades that others can't do. And that helps your Sharpe ratio as a result. Maybe smaller returns. I mean, it's important to remember that they are both long and short at any one time. They try to be market neutral. And it's all about relationships among investments. That's what they're looking for. They're looking for patterns that repeat, but it's about relationships. And again, there are trades that probably they have there's a lower bar for them because they have these great relationships with the street. They have these better terms, and it's a virtuous cycle as a result.
It's interesting. One of the things in one of the articles that we wrote that led to this call was that, and I kind of just wondered, is a RenTec a type of place that could only come into being via gradual evolution? And, hearing you talk, I think I'm believing that more and more, unless you tell me otherwise. But it seems like, you have to get the Sharpe ratio to get the relationships. You have to have a lack of competition. You have to have the collaboration. And so, one of the questions I had is, do you think that if you had $1 billion, you could go rebuild RenTec? And maybe those are kind of the same question. It's like, does this come via gradual evolution, or could somebody with enough money, a reasonable amount of money, not like $7 trillion, go set up RenTec in a year? What do you think about that?
I think it's hard. Listen, the other point that needs to be made is that there's a lot of good luck or serendipity involved as well, and they'll acknowledge that too. So I don't think Jim Simons set out with this goal in mind, but because he only hires from the worlds of math and science and not people from Wall Street, that he doesn't hire hedge fund managers or what have you, and they're out in Long Island. So he started the firm out in far out in Long Island, because that's where the school was, where he taught, Stony Brook. It wasn't for any conscious reason. He was living there, and he started the firm nearby. But as a result, I would argue they attract, not just because they were where they are physically, but also the types of people that they recruit. As a result, they only really hire people, non-Wall Street people that aren't going to leave and go work on Wall Street. So as a result, in other words, as you suggests earlier, they don't want to leave because they make so much money. And when they first join, they don't really care as much about the money. It's more the challenge. But then you get addicted to the money. So most of the time when they leave, they don't go. If you're tempted to leave Renaissance, you're not going to go work for Two Sigma or D.E. Shaw or somewhere. And as a result, you're probably going to go to a nonprofit world, academia, but as a result, you're more likely to be able to collaborate and share in secrets with each other because you're not as worried that the IP is going to leave. And again, could you set out to start a firm like that? I guess hypothetically, but that's serendipity. And also, again, in my book, I talk about Sandor Strauss. Sandor Strauss was a really crucial, important person at the firm for a decade or two, and he was the one who said, we're gonna not only are we gonna collect every kind of piece of data, but we're gonna clean it, make sure it's accurate. Jim Simons didn't tell him to do that, so Jim Simons lucked out by hiring Sandor Strauss, and he was an early obsessive data collector. So you need the good luck, and also, frankly, remember those who've read the book, how they Jim Simons almost pulled the plug on their equity trading effort. And today equity trading is about, 60 or so % of all their profits. And another 6 more months of losses, and he would have pulled the plug on them. But it just so happens that this guy, David Magerman, one day figured out that his boss, Bob Mercer, had made a mistake in the programming. And one of the numbers, it was an S&P 500 number in their risk models, wasn't updating. It was a static number. So if Magerman hadn't found that, or Jim Simons just gotten frustrated and pulled the plug, we wouldn't be talking about them. They'd be a nice, $1 billion or so fund making money in commodities and in those currencies markets. So you need a lot of good luck along the way to develop a firm like this, and I think they will acknowledge it. Some of them will acknowledge that as well.
Well, who doesn't need good luck, right?
Yeah.
But even though we've just said, they do not have these pots which other firms have, but at the same time, they will probably run, as you were just suggesting, different types of strategies, but all combined in like one bucket, in one pool, right? Long short equity being one out of N. I've heard a couple of people, but none of them come from RenTec, saying, well, like you said, they're always market neutral. They want to be long something. They want to be short something, though it's this gigantic algorithm that just combs through the markets and, finds patterns, some things that are too expensive relative to others. And then they have a spread position on, but it's not really distinguishable into kind of like systems in the sense that you could say I'm trading FX carry, right? Or trend, equity momentum, long short equity, these type of things. Did you get a feeling speaking to them what types of strategies they run and how they combine them?
Yeah, so as you suggest, it's very different from others. They have one model, and it's hard to, some of the people internally or people that have worked there and still work there see their feat as more like an engineering feat, being able to combine all these inputs. And it was difficult for a long time. That's sort of what Bob Mercer and Peter Brown accomplished on the equity side. They had good ideas, had good signals, but they weren't able to implement them well. They weren't trading to capacity. They were affecting the market too much until those guys came in there. And again, they consider it like an engineering feat, all these inputs into one system, which is really hard. And that's why that's one of the reasons why most firms don't have a single model, and single system. But in terms of various, I forgot the gist of that question. I apologize.
Yeah, what types of systems they may be running?
They right. It's not like that. For different systems, it's all kinds of different inputs and signals, and there's some and it's based on hypotheses, and they look at it like not man plus computer, but computer plus man. But it's not all computer. So I mean, let me take a step back. Actually, 99% of the time, the computer decides what to trade, what not to trade. So that's changed over time. And I write in my book about times and Jim and others stepped in a couple of times, and those are dramatic times, and that is the case. But that's just I highlight them because that's the most drama. But most of the time, the machine runs the trading. But they do see themselves as machine plus man, because there's a role for the human still, and that's in terms of coming up with hypotheses and collecting new data sets. And they're all about data, and that's kind of one of my takeaways from the research is just the importance of systems and the importance of data. And they were doing big data decades ago, before anybody it was a concept. So that's at the heart of who they are. They'll if you could come up with a piece of data, they've thought about it already. They've collected it. They've cleaned it. Just anything. And they test it all day long.
One question, one more on just the modeling. One of the more interesting things I found in the book was when you talked about the losses, and I think it was 2000 or 2001, forget the exact year, but when tech basically went into a bear market and they got clobbered. And okay, and I was just sort of amazed because from a cursory look, you're like, hey, if I have an account, I can log in and sort by winners and losers, and it takes me about 4 seconds to figure out where I'm losing money. And it took them days. And, this is like a big group of rocket scientists, right, more or less. So I just wondered if you could speak a little bit about your thoughts on why did it take them so long to figure out why they were losing money?
Yeah. If I recall, it was a couple days. It wasn't like days and days. But because there's an element of AI or machine learning in their system, they're not 100% sure sometimes why. They have a thesis, but they're not 100% sure why they're doing what they're doing. Again, they've got thesis or they've got a potential rationale. Sometimes it takes them a couple of days to dig into it. So the example you're referring to is in early 2000 when the tech bubble burst and they started suffering. And frankly, it wasn't worse than, the average investor was suffering. I don't think back then. It's just, and you guys know better than I do. I'm not a quant, but I can imagine it, or it's from talking to these Renaissance people. In some ways, it's a little scarier being a quant and suffering a huge downdraft because, well, I guess it depends what kind of quant you are. For them, it's scarier because if you've got machine learning and as an element of your system, you're not sure exactly. So let's say I'm a healthcare investor or tech investor, long short kind of guy. Okay, I blew it, but I know why. I'm getting my shirt handed to me. But they didn't know. They had to dig into it because, again, the system learns on itself. So the system had taught itself to chase, basically back then, to simplify, chase tech stocks, momentum stocks, and was purchasing too many of them. So they had to figure that out. I think that helps explain, at least to me it did.
Fascinating. What do you think are they up to now? Is there any new research that you think they're working on that you came across that they've mentioned, or is it kind of like a ship that they keep in operation and they'll work a little bit on the edges, but the core of the thing is kind of like set in stone and let's just run with it?
No, it's not that. I'll tell you that much. There's a real urgency within the firm. I'll tell you one thing that I've been interested about them the last couple of years is about how the market, until recently, and then we can talk about that in a second, the market has been changing in that you don't have as many doctors and dentists to take advantage of, meaning investors broadly had shifted over to ETFs and to index funds. And historically, RenTec does really well, or Medallion especially, being on the other side of the dumb money. And I don't mean just individual investors, but hedge funds can be dumb too, and the panic and the greed and the fear and all that kind of stuff. The emotions that they take advantage of, they have a better sense for where things are going short term again. And I think it helps them. Well, volatile markets help them, but I think also just dumb investors, pension funds, hedge funds, others. And historically they've done best in years of a lot of volatility. 2000, 2008, 2020, RenTec was up 76% last year. So I've posed the question internally, well, what happens when people just shift to ETFs and index funds? Won't that affect the market and affect the trends and patterns? And they've said to me, well, yeah, that would and that will, but it happens slowly over time, and we can adjust accordingly. Now, the real question I have, and I don't have an answer, I haven't really done much reporting on it yet, is what happens if this Robinhood phenomenon continues? The GameStop, the Wall Street bets. What if those investors stick around and patterns, new patterns in the market seem to emerge? I mean, GameStop, I can't recall anything like that. You could maybe make the argument that Tesla a little bit or Bitcoin, but Tesla had a bright future. Maybe GameStop does too. So if investors are going to start throwing money at companies like that, are Renaissance's models going to be able to adjust? And frankly, and the other funds haven't done well, and they're not doing great. I'm talking about Reef and Ridge and Rita, these outside funds that Renaissance runs for people today because they've kicked everybody out of Medallion. It's just their own money. So markets may be changing, and can Renaissance keep up? They haven't done well in those funds recently. Medallion has continued to do well. They explain it by saying that Medallion is a short-term oriented fund, and they have just many more data points when it comes to short-term patterns. Let's just say a one-day pattern for the market, or a 1 hour pattern, more likely for them. There are many 1 hour patterns, historic patterns that they can model and look at, many more than, let's say, a 1 year pattern. So Reef holds stuff for a year or so, or sometimes does. So they're just better they got more data. These are data people, so they've got more data when it comes to 1 hour patterns in the market than 1 year patterns. They do better with the 1 hour than the one year 1 year. But again, I don't know. What if the Wall Street bets crowd sticks around and things are never the same on on Wall Street and trading? Then I think it'll take a little while for Renaissance to adjust. But they hopefully on their part, hopefully they hope they will.
I mean, these markets are always changing. We can speak about GameStop and also, passive investing and all the flows. I mean, this has an impact, price insensitive buying and selling, right? Just, buying an ETF. Before we go there, and I also want to be conscious of your time, but you've mentioned 76% up in 2020. And 2020 was the year of the coronavirus. Remember March and April, right? There's really February, March and April. Did they just go through that period like, oh, well, thank you for the elevated volatility, we're now making even more money, and it's just like this straight line, or maybe even accelerating during that period? Or did they also have at that period some difficulty maintaining their returns? Did you see the granularity on that, like monthly returns or something like that?
I didn't see monthly, but I checked in with them in the spring, in the summer, end of the year, and they were making money that whole time. So no, and we're talking Medallion. There were no difficult periods for Medallion in 2020. They were loving life in 2020, yes. While we were all sort of scared about the future and our lives and our investments and nervous, the Medallion funds was churning out money, cash, almost every day, I would think. So yeah, no, they're just a unique beast. Again, the other funds had difficult years and have started 2021. REIF was down like 9.5% in January of 2021. So different models and different strategies, but yeah, I wouldn't lose any sleep over Medallion fund.
One question, just kind of away from the models and stuff, but you mentioned, you got access eventually, and clearly you still have it because you know what Medallion is doing, and I don't know that anybody but you does, except for people that work there. So curious, why did they give you access, and why do they keep giving you access?
I have a lot of compromising photos that no, I'm kidding. It's a great question. And to be honest with you, you could ask my wife about this to verify. I was up nights just scared a lot of the time I was writing this book that people wouldn't talk to me. And so about a third of the way through the project, we're talking months and months of work. After months and months of work, I had really good stuff, I thought, from the early period because, okay, those people already had retired. And, when you're really wealthy and you're like 70, you don't care about what Jim, others think about you. They don't have any power. So I did get access to those people, and I was thrilled to do so. But I was still up nights wondering, how the heck am I going to get people who currently work at the firm to talk to me? There's really no incentive to talk to me. And the risk is they lose this job at a firm where you can invest your money and make 76% a year. So they did eventually talk. And I think people talk because they've experienced something really special and unique, and the truth wants to come out, and stories want to come out, and people want to share their experiences, maybe not on the record, but as we call it on backgrounds in our world, where it's you can use it, but it's not something you can attribute to people in particular. And I also think some people maybe just didn't want inaccurate information out there. This is their legacy in some ways, and they're proud of it. And so maybe they would not necessarily tell me things that they should be telling me, but they would correct me if I had been misled by someone. So I'm grateful to those people and appreciative that they did open up.
It's interesting. I mean, so it seems like you were, persistent, and just eventually they wanted to get out there, and you became the guy and did the work, and there you go, right? So that's a good. Thanks for sharing that.
And you could also make the argument that Zuckerman's book is I think there are insights in there and there are signals and such. But my book is as much about the people and about the organization and about the history of really fascinating, accomplished individuals who deserve the acclaim, I think, because they've accomplished something really important. And I think, in terms of Jim, and Jim eventually talked to me too. And we spent hours and hours together. And again, he originally said he wouldn't talk to me, but I got him to talk. I didn't even need the compromising photos with Jim. But not that I have any. But he didn't give me secrets. Let me make that clear. They're trading secrets. But he talked about his life a lot, and there's real value to that. And because I would argue that Jim Simons is deserving of a book, even if he had never invested a dime in the market. He, as a groundbreaking academic, as a code breaker, going up against the Russians, as the stuff he's doing right now in the non-for-profit world and science, and trying to figure out the origins of time and solve autism in politics. What he and Bob Mercer have done has really changed the course of our country, the United States. So there are other reasons to talk to Greg Zuckerman and to read the book, even if it's not getting a signal that you hadn't thought about.
Well, many reasons to talk to you. Like I said before, I enjoyed reading all of your books, not only The Man Who Solved the Market, but The Frackers. And I think there's also an early one that I have about athletes and how they develop. Probably one of your earliest works.
That's with my two sons. I wrote 2 books with my 2 sons for young audience, but I'm glad you read it as well. And it's trying to be inspirational. It's about how athletes, superstars, overcame challenges in their youth. Mm-hmm. And we went and talked to them. And that's, racism and poverty and physical differences, abuse. And we were inspired by their stories, and we hope young people are as well.
So what's next for you? What's the next book? Can you share it?
I have a book literally up. I was up to 2:30 last night working on. I can't really talk about too much, but it's related to the crisis we're in right now. And I'm excited by it, and I'm fascinated. They're fascinating characters to me. They are anyway, and important themes. But I can't really talk about it just yet. But I can't wait to be done with it. And but not so much. It's an important project, I think. So I'm learning a lot. Hopefully, other people do and are entertained as well.
I've never written a book, but I can imagine, you want to get at some point, you want to get to the finish line, right? Because it is so much work and so much time.
Yeah, but you have to enjoy the journey too, because it's a lot of 2:30 in the morning in this basement here when it's cold and the family's sleeping upstairs, and you don't get paid enough. So unless you're really enjoying it and learning. So when it came to The Man Who Solved the Market, I learned so much personally. I'm a selfish person, so I do these books largely to learn myself and meet interesting people. So I would go to meet a scientist or mathematician out in Princeton, have lunch with them, an 80-year-old who worked with Jim Simons back in the 70s, and then we would talk about life and bringing up children and religion. So I'm a religious guy with a lot of questions, and these are scientists, and we would debate and discuss it. And so again, I'm selfish in some ways. It's an excuse to meet really smart, interesting individuals. And my new book is too, and it's about where we're going and broadly in this world and the crisis we're in right now. But so you want to be done with it, but you better, as a writer, enjoy the process, because you don't get paid enough. I don't even want to think about per hour what we're making on these things.
Yeah, I'm sure. So, well, George, unless you have any closing remarks, I thought it was absolutely fascinating. And, thank you very much, Greg, for coming on and having that chat with us. I'm fascinated by RenTec. I think all 3 of us continue to be fascinated by the firm. We'll, follow it as closely as we can. Nobody has as deep of a look inside it. You have, you've come closest to them, but maybe at some point in the future, we'll have an opportunity to reconnect and update ourselves on what it is that they're doing. Until then, thank you.
Sure. Stay well, everybody, and thanks for the opportunity. Nice to be in touch with you guys.
Thank you, Greg, and thank you, Moritz.